The final quarter of 2023 delivered a remarkable rally across most asset classes. This came as investors grew confident around the world that global inflation had been brought under control, paving the way for an expected interest rate cutting cycle in 2024. While the US Federal Reserve had previously pushed back against that sort of view, they pivoted their guidance late in the year away from their higher for longer commentary that had characterized previous quarters. Although Europe does show some evidence of economic stagnation, this was certainly not evident in the United States, where the data continues to show resilience in the broader economy as well as in the labor market. This despite the large interest rate increase that we had through 2022 and then the first half of 2023. On the face of it, it seems as though policymakers have managed to steer the US economy towards a so-called soft landing, which is an outcome that very few expected a year ago. We're not quite convinced of this yet, but certainly the environment looks a bit better than it did previously. This provided the backdrop for strong equity and bond prices, which is of course an encouraging development for investors. And if you were in multi-asset portfolios, it's good to see most of the assets go up. The US dollar weakened against most major currencies, losing nearly 5% of its value over the quarter against the basket. But mostly this was just giving back gains that had made previously in the year. This was driven by a moderation in real yields, which retreated from their post-financial crisis peak, but do still remain elevated relative to the last decade. The continued decline in inflation means that if the Fed reduces rates as expected in 2024, it will not be to stimulate the economy necessarily, but rather just to keep the real rates stable as inflation comes down. In South Africa, the key story of 2023 was unfortunately failing infrastructure from the electricity and logistics systems, and of course that dragged on sentiment. We are starting to see some green shoots from what is, of course, unfortunately a low base. In general, the sharpest contraction in US money supply over the last 60 years is having a far smaller impact than one might suspect on the overall global economy. Yes, there are clearly pockets of concern and the hints of potential problems, but overall, that US economy remains in rude good health. We know that monetary policy works with lags that vary by cycle. In this cycle, the combination of loose fiscal policy, excess savings, and fixed rate home loans have really slowed the transmission of this tighter monetary policy to the man in the street, who isn't really being squeezed as much as in prior cycles of similar kind of magnitude. We do still see, though, that in the developed world, inflation is above target and labor markets have yet to return to equilibrium. This combination of factors has created some uncertainty over the appropriateness of current monetary policy and therefore the future path of interest rates. And that, of course, will have significant repercussions for expected asset class performance over 2024. So, in this environment, we continue to believe that appropriate diversification actually becomes even more important, almost irrespective of your investment mandate. 2023 was the year of easing supply constraints, which together with China's economy being out of sync with the West's and lower energy prices allowed inflation to cool quite nicely. Strong recent investment performance, equity markets are clearly now pricing in a high chance of that so-called soft landing that I spoke about earlier. We have long-term inflation expectations in developed markets that remain quite well anchored, and we've seen very high levels of immigration into both Europe and the USA, which has helped to prevent labor inflation becoming too high. Whatever the macroeconomic environment brings in 2024, as always, our focus at Sanlam Private Wealth is on constructing portfolios for our clients that are robust to a variety of potential outcomes. In terms of asset class performance, most assets prices were up over the final quarter of 2023. Equities led the excitement there with the MSCI World and the S&P 500 indices, both up around about 11.5% for the quarter and up 24 and 26% respectively for the year. Euro stocks did even better. That was up 14% in dollar terms in the fourth quarter and about 26% for the year. The MSCI Emerging Markets Index lagged global averages, largely with China to blame. It still gained 8% in the fourth quarter, but was only up a relatively muted 10% for the year in dollar terms. From a style perspective within global equities, there wasn't too much in it in the fourth quarter. Growth stocks did perform best. They were up about 13%, value stocks up about 9%. The story over the full year, though, was much different, with growth clearly outperforming value. That margin was quite wide. Global equity markets were very narrow over the year, with much of the S&P 500's returns driven by just 7 stocks. If we think of things from a sector perspective now, the more rate-sensitive areas like technology and listed property benefited most from lower bond yields in the final quarter. They were both up around about 6%. By contrast, energy struggled as the oil price fell almost a fifth over the final quarter of the year. Global bonds finished the year strongly, gaining about 8% in the final quarter to be up almost 6% for the year. Bond markets quite liked the pivot in communication from central bankers in the developed world, but we are seeing some signs that the bond market is demanding increased reward for investors taking longer term risks, and that's really in light of the high current and planned budget deficits, particularly in the US, where they're running a high deficit. Commodity prices were a bit of a mixed bag through the quarter. Gold stood out as a beneficiary of those lower interest rate expectations, so gold was up about 12%. When looking at South Africa, the rand's volatility continued, with our currency fluctuating between 19 Rand 50 and 18 Rand 20 to the dollar over the quarter, ending at about 18 Rand 28. Our local equity market outperformed its emerging market peers. We were up about 11% in dollar terms in the final quarter of the year, although for the full year the number was only 2% in dollars. In rand terms, looks a little bit better. The JSE All Share Index was up about 9%, over 9% actually, in rand terms. Within our market, financials performed best while resources lagged. And our local bond market gained 8% over the quarter for a full year return of 10% in rands. And then cash delivered about 8% for 2023. The House View equity model's performance over 2023 was a bit disappointing in relative terms, where it underperformed its benchmark by about 2 percentage points to deliver 7% after fees, unfortunately due to a poor final quarter where we had looked quite good through most of the year. Over the last 3 years, though, this portfolio is in very good shape. It's returned 14.4% per year after fees, which is about 1% per year ahead of the benchmark and nearly 3% per year ahead of our average peer. In 2023, the stocks that we didn't own actually helped us more in relative terms. We had underweights to both platinum and diversified miners, which helped us out quite a bit. Our positions, though, in Sasol and British American Tobacco did act as drags through 2023. This portfolio remains in the top quartile of its peer group over 2, 3, 5, and 10 years, as well as longer than that as well. Our worldwide equity portfolio, that had a tough time of it in 2023, given the very narrow global market I spoke about earlier. Although this portfolio delivered a return of over 13% for the year in rands, this was behind its benchmark. While this portfolio did have some healthy exposure to growth businesses like Google and Microsoft, in general its positioning was tilted more towards defensive names in the healthcare sector, for example. We made some changes to this international component of the worldwide portfolio in December to provide a more balanced global exposure going forward. If we then move across to our Regulation 28 multi-asset portfolios, the short-term performance was also disappointing. The balanced, moderate balanced, and conservative balanced portfolios were all slightly behind their benchmarks over 1 year after fees, but like the equity portfolio, remained comfortably ahead of their benchmark over 2, 3, 5, and 10 years. These portfolios benefited from good asset allocation calls, but that couldn't outweigh the relative underperformance of the offshore equities component in the fourth quarter. In terms of activity in the equity portfolios, we deployed some dry powder in the quarter by adding to both FirstRand and Aspen in late October. That has worked quite well. In the balanced portfolios, we put some dollar cash to work in US government bonds in October, so they certainly benefited from that rally. Overall, our position across our client portfolios is somewhat less defensive than it was 3 or 4 months ago, but it does still remain slightly conservative given our concerns over the impact that the material tightening in global financial conditions over the last 18 months is likely to have on future economic growth. When we look at global equities, prices are distinctly higher than average on a forward sort of price to earnings multiple basis, and the market is definitely pricing in accelerating profit growth in 2024. We think that will be quite hard to achieve given our expectation that global economic growth will slow this year, maybe not go into recession, but we certainly believe it will slow. And of course, the enthusiasm for artificial intelligence in the market remains high. We have exposure there via companies like Microsoft, like Google, like Tencent as well. If we now shift our attention to South Africa, we have quite a different situation. Our stock market here is still looking quite cheap relative to both its own history and to global peers. Unfortunately, there are clear reasons for this, given the struggles, particularly within the state-owned enterprises in South Africa. As we look ahead to 2024, South Africa's 7th democratic election, it's likely to be the most tightly fought yet, that could create some market volatility, particularly in the lead up to that election. On a global scale, it's quite exciting for advocates of democracy. We'll see around half the world's adult population allowed to vote this year in some key countries like India, the USA, Mexico, and as I mentioned, South Africa. Some might see this as adding risk, but do remember that voting typically strengthens democracies, allowing us to pop out the other side probably with more certainty about life. We expect another year, unfortunately, of fairly anemic growth in South Africa, but we do remind clients we have been preparing for this for some time by tilting our portfolios to make them more robust to a low growth environment through both our more defensive equity selection within SA as well as through our asset allocation. SA stocks, though, should probably do a bit better than the overall economy just because they're coming off a low base because of the aggressive load shedding that we had last year that dampened earnings. So we can grow off that low base. From a global equity perspective, valuation and earnings expectations do remain above trend, and they are offering a relatively low risk premium over bonds. By being more circumspect now, we believe we're hoarding so-called dry powder to deploy into more risky assets once prices become more attractive in the future. So in conclusion, we still believe that we are in the latter stages of the investment cycle, which means that we shouldn't allow recent good performance to make us complacent. There are multiple possible macroeconomic outcomes, so we will continue to focus on building well-diversified portfolios for our clients that are robust to a wide variety of potential scenarios.